While mainstream headlines tell you gold is dead because stocks are hitting new highs, the real data is flashing a very different signal. Wall Street is watching the S&P. Central banks are quietly stacking gold. That divergence matters. And if you know how to read the news properly, it can put you on the right side of the trade before the move happens. This isn't about reacting to headlines. It's about using them. Let's start with what the media consistently misses. Gold and silver don't trade on opinions. They trade on stress, inflation, interest rates, geopolitical risk, currency confidence. When inflation data like CPI or PPI comes in hot, the headline usually says, "Markets digest inflation report." What they don't emphasize is this: inflation destroys the real value of cash and bonds. That's oxygen for gold and silver. Now look at interest rates. Mainstream coverage focuses on what the Fed says. Precious metals react to what the Fed does, and more importantly, to real rates. When inflation runs hotter than interest rates, real yields fall. Historically, that's when gold performs best, even if the Fed sounds aggressive. Employment data tells a similar story. A strong jobs report is framed as good for the economy. But strong employment can delay rate cuts. Delayed rate cuts can pressure metals in the short term. That's where weak hands sell, and where informed investors prepare for the next leg higher. Now zoom out globally. Wars, trade conflicts, elections, every spike in uncertainty forces capital to seek safety. Here's the part rarely discussed on mainstream TV. Central banks, especially outside the United States, are buying gold at an accelerated pace. China, Russia, the Middle East. This isn't speculation. It's a structural shift away from dollar dependence. Silver adds another layer. It's a monetary metal and an industrial one. Solar panels, electrification, green infrastructure. When global growth expectations rise, silver can outperform gold. When fear spikes, silver often lags, until it suddenly doesn't. That delay is where opportunity lives. And finally, sentiment. When financial news is universally bullish on equities and dismissive of precious metals, that's often a late-cycle signal. Excess optimism at the top, maximum skepticism near the bottom. News doesn't just inform you, it reveals crowd psychology. So what does this mean for your portfolio? Stop trading headlines emotionally. Start tracking how different types of news shift incentives. Rising inflation? Watch real yields. Hawkish Fed talk? Watch bonds, not speeches. Geopolitical risk? Watch gold's reaction, not pundits. Central bank buying? Think long-term, not day trades. Combine fundamentals with technicals. Let the news tell you why. Let the chart tell you when. And manage risk aggressively. News-driven markets move fast and punish overconfidence. Here's the truth: most investors learn too late. Mainstream financial media explains moves after they happen. Your edge comes from understanding how news changes behavior of governments, central banks, and global capital. Gold and silver aren't outdated. They're signals. If you learn to read the news beneath the headlines, you won't just watch the cycle, you'll trade it. Now I want to hear from you. Do you use economic news as a trading tool, or do you think it's mostly noise designed to mislead retail investors? Drop your take in the comments, and let's break this down together.